If you drive, deliver, or freelance, the money hitting your app is not all yours. This video shows how much to save for taxes and how to automate it before tax season hits. Every payout feels like pure profit when no one takes taxes out first. That feeling is exactly what gets gig workers into trouble later. Unlike a traditional paycheck, gig income arrives untouched. There is no employer quietly setting aside money for taxes on your behalf. When a client pays a freelancer, the entire amount lands in their account. Nothing is withheld, which means nothing has been prepared for. None of them had a single dollar set aside for taxes. That quiet gap between gig income and traditional payroll is where trouble begins. A traditional paycheck already has taxes removed before it reaches you. A gig payout does not, which means the full number can be misleading. When the full payout looks like income, it gets spent like income. Rent, groceries, and small purchases quietly use up money that was never fully theirs. Then tax season arrives. The number owed is larger than expected, and there is no cushion of savings sitting quietly in the background. Seeing a large balance due for the first time is unsettling. For many gig workers, this is the exact moment reality catches up with them. Some gig workers consider a short-term loan to cover the surprise balance, not realizing it adds new financial pressure they will carry for months. Others reach for a credit card instead, covering the balance for now while quietly building a new source of ongoing financial pressure. When the amount owed feels too large to face, some gig workers delay filing altogether, letting a manageable problem grow slowly larger. This pattern repeats across millions of gig workers every year. It is not a personal failure, it is a missing system that no one explained. What all three of them were missing was simple: a specific percentage set aside consistently before the money ever felt like spending money. Instead of guessing, gig workers need one reliable number, a percentage of every payout that goes straight into a separate account every time. Gig workers pay more than income tax alone. They also owe self-employment tax, which covers Social Security and Medicare that an employer would normally split. Self-employment tax alone typically runs about 15% of net earnings. That is before any regular income tax is added on top of it. On top of self-employment tax, regular federal income tax still applies to earnings. The two combine to form the real total owed. Combined, most gig workers should plan to set aside somewhere between 25 and 35% of every payout for taxes. The exact percentage depends on total income for the year. Lower earners typically owe less, while higher earners typically owe more. Someone earning modestly from gig work may land closer to 25%, since lower income often means a lower overall tax bracket. Someone earning significantly more from freelance work may need closer to 35%, since additional income pushes into higher tax brackets. The IRS expects self-employed workers to pay estimated taxes 4 times a year rather than waiting until one single date every April. Paying everything at once in April, instead of spreading it across the year, can lead to an underpayment penalty on top of taxes owed. Business expenses like mileage, equipment, and a home office can lower taxable income, which means the percentage owed can shrink over time. For a driver, every mile logged for work can reduce taxable income, meaning careful tracking directly lowers the amount eventually owed. Deductions are not a trick or a loophole. They simply reflect real costs of doing gig work that reduce the income actually taxed. Here is the core answer. Every time you get paid, immediately set aside a fixed percentage between 25 and 35% for taxes. The formula is simple: gross payout, multiplied by your chosen percentage, transferred into a separate account before you spend a single dollar. Step 1 is tracking gross income, the full amount before any expenses, every time a platform sends a payout to your account. Step 2 is applying your chosen percentage to that gross amount, based on your income level and how many deductions you typically claim. Step 3 is the most important. Transfer that percentage into a separate savings account the same day the payout arrives without delay. The system works best with 2 separate accounts, one for everyday spending and one that exists only to hold money for taxes. The first account holds money that is genuinely yours to spend freely on rent, groceries, and everyday life without a second thought. The second account holds money that was never really theirs to spend. It sits untouched, quietly waiting for quarterly or annual tax payments. Automating the transfer removes the temptation to skip it. Many banking apps allow automatic transfers the moment a payout is received. Once automated, the system runs quietly in the background. Every payout splits itself without requiring willpower or daily decision-making. Transferring the same day removes the temptation to spend it first. Money that never touches your spending account is never missed. To recap, gross payout times your chosen percentage between 25 and 35 transferred immediately into a separate, untouched tax account. The first common mistake is waiting until the end of the year to think about taxes at all, instead of starting with the very first payout. The second mistake is guessing a low percentage that feels comfortable in the moment, rather than calculating a number based on actual income. The third mistake is dipping into the tax savings account for emergencies, treating it as available money instead of money already owed. The fourth mistake is failing to track deductible expenses throughout the year, which means paying more tax than actually necessary. The fifth mistake is ignoring quarterly deadlines entirely, letting all estimated payments pile into a single stressful date each spring. The sixth mistake is mixing personal and business spending in one account, which makes it nearly impossible to track true taxable income. The seventh mistake is keeping the same percentage even as income grows, when a higher income often calls for a higher rate. The eighth mistake is relying only on a gig platform's built-in earnings summary, which often does not account for personal deductions or total tax liability. The ninth and most common mistake is never opening a separate account in the first place, leaving all income mixed together with no clear boundary. Together, these mistakes turn a manageable, predictable expense into a recurring source of unease every single tax season, year after year. Consider Mia, a rideshare driver earning a steady weekly amount. Based on her income level, 28% is a reasonable number for her to set aside. Mia opens a second bank account specifically for taxes and sets up an automatic rule to transfer 28% of every payout. Consider Jordan, a delivery courier with more modest earnings. For his income level, 25% is a more appropriate number to set aside. Jordan also starts logging his delivery mileage daily, knowing that each tracked mile slightly reduces the taxable income he will eventually report. Consider Amara, a freelance designer with a growing client list. For her higher income level, 30% is closer to her ideal number. Amara sets up her own automatic transfer rule, moving 30% of every client payment into a dedicated tax savings account immediately. A simple spreadsheet can track gross income, the percentage saved, and running totals, giving a clear picture of tax savings at any moment. Marking quarterly due dates on a calendar at the start of the year removes the guesswork and prevents any deadline from being missed. Most banking apps allow a standing rule. Whenever a deposit arrives from a gig platform, a set percentage moves automatically to savings. A simple habit of photographing receipts the moment they are received keeps deductible expenses organized without any extra end-of-year effort. Reviewing income in the chosen percentage halfway through the year allows small adjustments before any major shift in earnings causes a surprise. With the system in place, tax season becomes a routine paperwork task instead of a financial emergency because the money was already set aside. Takeaway 1. Set aside between 25 and 35% of every gig payout, adjusted for your specific income level and deductions. Takeaway 2. Open a separate account a day, even before calculating an exact percentage, because the structure matters more than perfection.
And you're on your way. Let's start.
Takeaway 3. Track mileage, equipment, and home office expenses consistently, since these deductions directly reduce the amount eventually owed. Takeaway 4. Pay estimated taxes quarterly when possible, spreading the total burden across the year instead of one single spring deadline. Takeaway 5. Revisit the chosen percentage whenever income changes significantly, since a higher or lower year can shift the ideal number. Takeaway 6. For complex situations, a qualified tax professional can fine-tune the exact percentage and catch deductions easy to overlook. With these habits in place, all three of them now face every payout with the same quiet confidence instead of quiet uncertainty. To summarize, taxes are not optional and not unpredictable. A consistent percentage, saved immediately, turns a yearly surprise into a routine habit. Picture a quiet morning in April with no dread, no scramble for cash, and no unexpected bill. Just a routine task already handled. When the money is already set aside, tax season stops being a financial emergency and becomes simply another item on a routine checklist. If this gave you a clearer plan for your own gig income, tap like, leave a comment with your percentage, and share it with someone who needs it. Subscribe for more practical, no-jargon guidance on managing gig and freelance income, so tax season never catches you off guard again.